For decades, venture capital thrived on intuition, personal networks, and pattern recognition. Investors relied on their experience, gut instinct, and connections to identify promising startups and determine which companies had the potential to succeed. They cultivated relationships, attended industry events, and waited for founders to pitch their ideas. But today, the landscape of venture investing is undergoing a radical transformation. Artificial intelligence, machine learning, and big data analytics are fundamentally changing the way capital is deployed, shifting the industry from an art to a science. In an era where startups can emerge and scale faster than ever before, traditional methods of sourcing deals, conducting due diligence, and making investment decisions are no longer sufficient. Data-driven venture capital, powered by AI, is reshaping how firms identify the best opportunities, predict success, and allocate resources with greater efficiency and precision. This shift is not just about using AI as a tool, it represents a complete reimagining of how venture capital operates. Investing is becoming more data-centric, enabling firms to move beyond subjective decision-making and gain a competitive advantage in an increasingly fast-paced and complex market. So, what exactly is data-driven venture capital? At its core, it is an approach that leverages AI, machine learning, and big data analytics to revolutionize the investment process. AI can identify high-potential startups before they even start fundraising, evaluate teams and market trends using quantitative signals, and optimize investment strategies with predictive modeling. Traditional VC firms often rely on warm introductions, human judgment, and a limited set of data points. In contrast, data-driven firms harness AI to scan millions of data points across public and private databases, job postings, social media activity, patent filings, and more. This enables them to uncover hidden opportunities, startups that might never have come across a traditional investor's radar. One of the most significant applications of AI in venture capital lies in deal sourcing. Traditional deal sourcing depends heavily on personal connections and inbound pitches. But data-driven sourcing introduces a systematic, technology-driven approach. By leveraging AI, firms can scan vast amounts of information, tracking key startup indicators across multiple sources. Startups leave digital footprints across platforms like LinkedIn, GitHub, Crunchbase, PitchBook. AI tools scrape and analyze these sources, identifying new companies, monitoring hiring trends, and assessing market traction in real time. AI is also helping firms analyze deeper layers of startup activity. Natural language processing can assess patents, research papers, and industry reports, surfacing deep tech startups long before they commercialize their innovations. This proactive approach ensures that investors stay ahead of the curve. Instead of waiting for referrals or demo day presentations, investors can now find breakthrough companies before they enter mainstream venture pipelines. AI is not just transforming outbound sourcing, it is also streamlining inbound deal flow. Digital platforms and AI-powered chatbots enable startups to submit funding applications, which are then automatically screened for key success indicators. This automation reduces unconscious bias, ensuring startups are evaluated on objective metrics rather than personal connections or backgrounds. Instead of manually reviewing thousands of pitch decks, AI filters applications in minutes, surfacing only the most relevant opportunities. This makes the entire investment process more efficient, accurate, and scalable. Beyond deal sourcing, AI is transforming how VCs assess risk and conduct due diligence. Instead of spending weeks manually analyzing financials, market trends, and competitive landscapes, AI can rapidly process vast amounts of information, founder backgrounds, startup traction metrics, customer sentiment, web traffic, and hiring velocity. Startups do not always advertise their success openly, but AI can read between the lines. Hiring patterns can signal expansion, web traffic surges indicate rising user adoption, and increased app downloads suggest growing traction. AI tools monitor these metrics alongside customer reviews, revenue trends, and even GitHub activity, allowing VCs to independently verify momentum without relying on self-reported metrics. This allows investors to make faster, more informed decisions, reducing the risk of making costly mistakes. Perhaps the most revolutionary aspect of AI in venture capital is its predictive capabilities. By analyzing thousands of past investments, AI can detect patterns that correlate with startup success, assign probability scores to new ventures, and provide data-driven insights into which companies have the highest likelihood of scaling or achieving successful exits. This kind of predictive modeling gives VCs a level of foresight that was previously unimaginable. One of AI's most powerful applications in venture capital is its ability to analyze historical funding data and identify the traits most likely to correlate with long-term success. Machine learning models rank startups based on their potential for growth, successful fundraising, or a high-value exit. Some firms even use algorithmic filtering, where AI continuously refines investment criteria based on past winning deals. This predictive modeling allows VCs to focus their efforts on startups with the highest potential, prioritizing deals that align with historical patterns of success. AI's impact does not stop at the point of investment. It also plays a crucial role in portfolio management, tracking performance in real time, identifying when startups need additional funding, and even recommending optimal exit strategies based on market conditions. By integrating AI throughout the investment lifecycle, firms can allocate capital more efficiently, ensuring that resources flow to the most promising opportunities. Several VC firms are already pioneering AI-driven investing, setting the stage for the industry's future. Some firms have built proprietary AI systems that analyze vast amounts of venture data, helping them predict startup success with remarkable accuracy. These firms are proving that venture capital is no longer just about intuition. It is about leveraging information in ways that traditional investors simply cannot match. The benefits of this data-driven shift are clear. AI-powered VC firms enjoy better deal flow, reduced bias, faster decision-making, and higher accuracy in identifying high-potential startups. AI also eliminates the limitations of traditional networks, ensuring that promising companies, regardless of geography or background, get the attention they deserve. It accelerates deal flow, allowing firms to analyze thousands of startups simultaneously. It expands access to opportunities beyond major tech hubs, uncovering high-potential companies that might otherwise be overlooked. It enhances decision-making by focusing on objective data rather than intuition alone. And by reducing bias, it opens doors for a more diverse range of founders to receive funding. As competition in venture investing intensifies, firms that embrace AI will have a decisive advantage over those that rely solely on old-school methods. Of course, AI in venture capital is not without its challenges. Some industries, like quantum computing and synthetic biology, lack the historical data needed to train effective AI models. Human judgment still plays an irreplaceable role in assessing founder chemistry, vision, and adaptability, elements that no algorithm can fully quantify. There is also the risk that AI models, if trained exclusively on past successes, might overlook unconventional startups that do not fit traditional patterns. And as AI becomes more integrated into the investment process, ethical concerns around data privacy and surveillance must be carefully addressed. Despite these challenges, the future of venture capital is unmistakably data-driven. As AI adoption grows, we can expect to see more investment platforms powered by machine learning, more funds integrating AI into their decision-making processes, and more hybrid models where human investors work alongside AI to maximize returns. The firms that embrace this shift will not only survive but thrive, outperforming their traditional counterparts, much like algorithmic trading reshaped hedge funds in the public markets. The venture capital industry is no longer just about relationships and intuition. The firms that will define the next generation of startup success are those that master data. The best investors of the future will use AI to surface opportunities before competitors, automate due diligence for faster and smarter decision-making, and employ predictive analytics to build stronger portfolios. By combining human expertise with AI-driven insights, they will position themselves at the forefront of the evolving VC landscape. Because in the world of venture capital, those who harness the power of AI will not just be investing in the next big thing, they will be shaping the future itself.